Hi folks, welcome to this short video on how to prepare a multi-step income statement. This type of income statement is a little bit different from what you've done in your prerequisite courses because it includes a segment that we call a discontinued operation. And what do we mean by a discontinued operation? Well, in short, a discontinued operation happens when a company, whose income statement you're doing, decides to sell or get out of one of its lines of business. So they might decide to sell a line of business to a competitor or just to wind it up indefinitely or totally. An example of when this can happen is, say for example, the Gap chain of retail stores decided to sell its Baby Gap division. It still may want to operate other areas of its company, but perhaps that one, maybe it's not profitable, or perhaps it doesn't fit with their business strategy. So when a company makes that decision, there's two things that we need to do. Number one, we have to show, as part of that discontinued operations section in our income statement, any gain or loss that the company may have incurred while they were operating that discontinued business segment while it was up for sale. And number two, we have to show any gain or loss once we sell that discontinued segment. Both parts, the gain or loss while we're operating the discontinued business segment while it's for sale, and the gain or loss once we do sell it, are both shown net of tax. Why? Because income from continuing operations, which is the number to which this discontinued operations profit or loss gets added, is already net of tax. So let's see how that would work. So in our example, and again, I guess I should have said at the beginning, it would probably be a really good idea if you had your textbook or your ebook handy with the problem that we're reviewing. In the script that I posted, I actually give you the exercise number in your text to which this problem applies. So if you want to see the question, it would be definitely easier for you to follow along with the solution. So in our case here, if you look at the data that we're given, we can see that we were given sales and cost of goods sold in the problem, so we can calculate gross profit. You'll notice we were also given some operating expenses, specifically salaries expense and depreciation expense. So we can calculate total operating expenses and come up with operating income on this line here. Okay? Now, so far it looks like what you've done in your prerequisite course. A couple of parts here are different though. In the other revenues and expenses, you guys would be used to seeing things like interest revenue, interest expense, dividend revenues, those kinds of things. In this case, they have an odd account. It's called a gain on expropriation of company property. So what does that really mean, and why is it considered an other revenue and expense? Well, I've given you a little definition down here. An expropriation really occurs when, say, a government is authorized, because of the jurisdiction within which it operates, to take the private property and not take it without buying it, but buying it from the company at a particular price. Sometimes this happens in areas where there may be some political unrest, or it might just be part of the agreement that you have if you want to locate a company in a foreign country. It can occur more locally or closer to home here in Canada as well. It can occur when a public agency, say it's government, say it's municipal government, a federal government, even a provincial government, they might decide that they want to take some private property, maybe property that your business is located on. Maybe they want to put a highway through it and they think it's gonna help the roadway systems. Maybe they want to build a school on that property. Whatever the government wants to build, they would come to you and make an offer to purchase that from you. So that's what we refer to as an expropriation. Okay? So when you sell that property to that government, whether it's a government in a foreign country or even one of our own governments here locally in our own country, if you sell it, in this case, we've just said you have a gain. Now that gain is before tax, and it's $264,000. So maybe in this case, the expropriation was maybe the city of Hamilton came by, said we want to get rid of some of these houses because we want to put a highway through it, right? Just like we did the Right Hill Expressway, same kind of thing, right? And they do, and they buy your property from you. They pay you a market rate. In this case, when they did that, you had a gain when you sold it to them, $264,000. So now I'm going to add that to the operating income that I calculated to get my income from continuing operations, and that's going to be income before tax. All right? Now, in the question, it gives me, I'm just going to expand this a little bit because I'm not sure how it comes up on your screen, but it also tells me that there's income tax expense. And if I look at the question, they didn't give me a tax rate, but they did tell me what the income tax expense is. And it's $190,200. So I'm going to deduct that from my income from continuing operations before tax in order to get my income from what we call continuing operations. That's income that you earn based on operating your business, strictly from your own operations. So now, to this, I need to add my discontinued operations income or loss. In this case, I have two elements that make up that discontinued operation. First, when I was operating my division, I incurred a loss while it was up for sale. So it was up for sale, I was operating it, and I didn't make any money. The question tells us that our loss, net of tax, was $333,000. So that is an after-tax number. So it can get added to this after-tax number. But we're not finished. Remember, the discontinued operation has two elements to it. So whatever we get at net, we're going to add to this number on an after-tax basis. The only thing you have to remember here with a discontinued operation is that you do need to show the net of tax amount. In this case, it's a benefit, because on a loss, we don't pay taxes. So we get a tax credit or a tax break from the government of $111,000. Now that question gave us what the tax break was. So we just put it in here. So at net, we have $333,000 after tax loss. So our loss would have been bigger. In fact, our loss would have been $444,000, right? It would have been $444,000, and because we're going to get a tax credit or tax back, then that means our loss is reduced by the amount of the tax we're going to get back, so our loss is only $333,000. But when we sold the operation, we got more money than we thought we'd get. After tax, we got $405,000 on it, right? So we got $405,000 after tax, and we were told that the income tax that we had to pay was $135,000. So whatever the amount of the gain was before tax, we remove the $135,000 in taxes, and we come up with $405,000. That's an after-tax number. So if we add this gain to this loss, both of which are after tax, we have an after-tax gain on discontinued operations of $72,000. We can add it to this after-tax gain, and we get net income of $456,300. So this concludes our short video introducing you to the multi-step income statement, including discontinued operations. I hope you found our presentation helpful.